all in all, I think we're setting up for a pretty strong back half of the year in 2025.
I love being an underdog. I will take all of that feedback and we'll shock the world.
We're talking about two fintech giants today, SoFi and PayPal. Both are hated by the market right now. Could this be a huge opportunity, or is it time to dump these stocks? Let me also share a little secret with you. We're up over 50% already on our teaching portfolio this year, over 100% in both of the last 2 years. And guess what? Next week, I'll be hosting a 3-day masterclass to show you how we do it. For 3 days at 8 p.m. Eastern Time, I will teach you for an hour each day what trade to set up and when, and how to automate profit taking and risk management so you too can trade in just 3 hours a week, potentially like we do. Visit felixprehn.org/masterclass. Link is down below in the description and secure your free spot now. SoFi's CEO just made a stunning statement. Let's watch it together.
Before we talk about your business, I want to talk more big picture about the conversation here in Sun Valley, specifically about the state of the economy, given your purview through your business, as well as the conversations you've been having with other CEOs. What's your sense of the economy right now?
Yeah, I'd say the conversation really kind of pivots around 2 points. One is where's the consumer, how are they performing from a credit standpoint, and where are interest rates going in the economy. On the interest rate point, we came out of Q1 having reported 26% year-over-year revenue growth with really no growth in our lending business, which is a really strong quarter, and we're really pleased with how things have gone since then. We've came out of that quarter thinking there'd be 1 to 2 rate cuts and positioned our business to do that, which would give us still attractive revenue growth, maintaining profitability, but just as importantly, having a strong balance sheet to take advantage of when rates go down. I think the consensus view is starting to come into picture, and people believe we'll continue to get the data points on inflation, continue to see an uptick in unemployment, but not too bad, and we'll have 1 to 2 rate cuts by the end of the year, which would be really positive. As it relates to the consumer, we've seen really good trends in spending. We've seen really strong demand for refinancing personal loans as people are trying to lower their debt so they can make sure they're planning for the future. So overall, our company's performed really well in this environment. I'm glad we took the stance of lower rate cuts than everyone else because it's positioned us now to benefit when rates start to come down. So I like how we're positioned. And for the first time, I'd say in 2 years, there's a more central consensus view about rates and where credit is. And credit actually has performed relatively well throughout the year. And that's something I heard from a couple CEOs last night. And we're really happy with where it's performed as well, in line with our tolerance levels and our expectations. So all in all, I think we're setting up for a pretty strong back half of the year in 2025 if we get the right fiscal policy.
Well, we're going to talk more about fiscal policy.
Okay, so it's kind of interesting. He's saying lower interest rates will help us. They've been quite cautious on their predictions on the economy. They've been quite negative, quite bearish, really. And that's kind of part of NOTO's plan generally to sandbag expectations. So they essentially pretty much stopped lending. And they're saying, well, we don't know what's going to happen with the economy. Plus also, as interest rates come down, they'll be able to borrow at much lower rates. And that's actually the moment when fintech companies, when banks start to really pick up again.
In a minute, but I just want to return to something you said. I know you've been introducing new things such as alternative investments, but also you mentioned you're not doing as many student loans. What is behind that policy, and where are you shifting your focus to effectively follow or lead consumers and where you want to be growing the business?
Sure. As we came into 2024, there was a view that actually rates would be cut 4 or 5 times. And we believed that for rates to be cut that frequently, there would have to be a recession or some type of underlying problem. It turns out we'll get 1 to 2 rate cuts, which is where we've been positioned. And as we thought about the environment and thought about how much we invested in our financial services business, our SoFi Money product, our SoFi Invest product, our credit card product, as well as our technology platform, we had an opportunity to drive really strong growth there at 50% and really pull back in the lending business to be more conservative, to wait to see where the economy shakes out, where interest rates shake out. And now we're coming into a picture where that's a lot clearer. So we've delivered really strong growth without really using the lending business to help drive it. And now we're in a position where, as we go into 2025, to use both.
Okay, that's a big shift. So he's basically saying we had our brakes on the lending business, where we've been gone full throttle on the whole financial services, other stuff, tech stuff. And as we go to 2025, he'll be able to go full throttle on both, which should significantly improve growth and revenue and valuations and earnings per share.
Now, of course, your business all started with student loans. And then just last week, a federal appeals court allowed a key part of Biden's student loan repayment plan to resume, staying in an order that had temporarily blocked it. Now, there's been a lot of back and forth on this. But how does Biden's efforts to repay student loans impact your business? And how do you see some of these legal changes and sort of the whole appeals process and the outcomes impacting your business going forward?
Yeah, we've really focused on people that have private student loans. Those are people that are still managing their cost and giving them cost savings on refinancing their private student loans, and that's been a smart strategy. It's a much smaller percent of our business. We gave guidance that we'll do close to $2.5 billion of revenue this year. We'll see really strong growth from the other businesses, so we're much less dependent on it. The fact that we grew 26% year over year in Q1 with no growth in lending overall is a great indication that we've invested in other areas that are really paying off for us. And the response that we're seeing for consumers in our SoFi Money product with 4.6% interest rate, SoFi Invest product, as you mentioned, offering them alternative assets and now IPOs, we've seen a great response there, and it's allowed us to go after other growth areas and not be so vulnerable to the whims of where the political or winds are blowing as relates to student loans. I will say this, we've done well with a high rate environment and uncertainty around credit. I'm really excited about what will happen when rates start to come down, and you can start to see the light at the end of the tunnel. When rates come down, we'll see a real pickup in student loan refinancing. Right now, there are people with rates at 7 to 8% student loans, but we only can offer them in the 6s. As rates come down, we can start to offer them in the low 5s and maybe in high 4s. So that business will pick up. Our home loan business had historically been a
All right, let's check out PayPal.
PayPal getting an upgrade from Susquehanna to positive from neutral, citing valuation for the upgrade following the stock's recent decline. So, Boris, what's your trade on PayPal?
So this is a really interesting story because, yes, from a valuation point of view, 5-time cash flow, 13 times earnings, it looks kind of really good. But I think from a secular point of view, I am very, very cautious on the stock. PayPal has a lot of competition right now. It's number 7 in China, very much at the bottom of the cellar in the leading place where there's digital payments. And with Apple Cash coming out, I've seen the Apple Cash demo, very slick, the ability to be able to pay somebody out of messages, kind of very slick. I think it's very, very hard for these guys to compete going forward. And to me, in order to be able to get long on the stock, they're going to have to see actual customer growth instead of just financial engineering. And until that happens, I'd very much be a hold at this point.
Well, the market is just bearish. It just hates fintech right now. And it makes sense. High interest rates, uncertainty about when rates are going to come down means you create this horrible environment where everybody hates small banks and fintechs and lenders. And these companies are lumped into this. And this doesn't help.
Since Alex Chris has come in, I've gotten renewed faith in PayPal. I know that there's a lot of competition, but this gentleman seems like he really knows what he's doing. I would hold on to it, but I wouldn't want to buy more until I see more better numbers.
The inverse Kramer indicator is hopefully still accurate. All right, so PayPal. This company has been a pioneer in digital payments, and their recent AI-driven innovations are promising to be game changers. Their algorithms are enhancing fraud protection and therefore improving not just the customer experience, but transaction approvals. And the more transactions are approved, the happier merchants are. Imagine you're selling a product online every 2 seconds. And every 10 seconds, one of those payments doesn't go through because your payment processor rejects the card of the person paying because they're not sure if they're legit. That's the problem that large merchants face online. So they go to the company that has the highest percentage of payment approvals. And that company, by a huge margin, is PayPal. Why? Because they have the most data. 40% of all online transactions for major merchants go through PayPal. And the more data you have with a good AI algorithm, it means you know your customers. It means you know the people are going to pay, and therefore you can approve them much, much more easily and at a higher rate than everybody else. And yes, PayPal is still a construction site, and PayPal would do well to spin off or shut down those non-performing parts of the business that the previous idiot of an CEO acquired. And we'd also love to see a clear roadmap from management that would say, look, in Q3, we're going to do this. In Q4, we're going to do this. And next year in Q1, we're going to do that. That would be really, really nice. In the meantime, I'm holding this with a horizon to hold until 2026. Because there's one thing I've learned investing for over a decade is that patience is key to building wealth. Now let's sum up SoFi. It isn't just a fintech company, it's a financial ecosystem. You've got student loans, you've got investment services, and they are leveraging AI to provide personalized financial solutions, which is essentially a personalized, friendly, warm sales pitch when you log into your app. And in addition, their AI-driven credit underwriting is particularly impressive. It means they can offer more competitive rates while managing risks very well than a lot of the other banks who don't know what A and I stands for yet. But as a small bank, SoFi is lumped in with all the US regional banks managed by absolute idiots and who would largely be bankrupt right now if the Fed wasn't bailing them out every other day. SoFi has nothing in common with them, but the market doesn't get it. So I see it as an opportunity to go back to $10 when interest rates start coming down, because at the end of last year, when we were around that $10 mark, that was because the market was expecting 4 or 5 rate cuts in the next 12 months. Winston's nose never lies, who's done all the research here. So why are these two stocks a must buy? It's simple. I think their use of AI and the unfavorable high interest rate environment coming to an end makes them good contrarian plays in the current market. Come and join us on Tuesday, Wednesday, and Thursday at 8 p.m. Eastern Time, where I will teach you something different every single day to make sure you understand what trades to set up, how to automate the profit taking, how to automate the risk management, and just grab yourself a free seat at felixfriends.org/masterclass to grab yourself a spot. And I love you for watching. If you enjoyed the video, share it with a friend or a golden retriever.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate.
We didn't realize that the second half of last year was going to be an extraordinary year from a growth standpoint.
Today, we're diving into Tom Lee's top stock pick to buy right now ahead of the potential Fed